Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday time. Gonna try to not put on my doomer hat too hard here, but man, is it tough. Let's take a look at crypto flows first quickly from James at CoinShares. Institutional flows, the highest last week out of crypto products since earlier in the year. And for me, maybe it's just a coincidence, but hey, I see the 3 highs in price here on the Bitcoin chart based on the flows. So I can't imagine we are magically bullish if the flows are negative, especially to this degree. Now, if you dig into this a little bit, he specifies it's mainly in Canadian and German products. Short Bitcoin ETF flat on the week, but negative 107 million on the week. Not a bullish sign for price, certainly. Had some interesting news today on the stablecoin front that wasn't Tether related. PayPal's launching a poorly named stablecoin. I guess PPUSD was a bad idea and or taken, but it is built on Ethereum, which is interesting. It is backed by Paxos. So look, good for them. I don't hate it. I don't know who's going to use it, but good for them. And if you look into it, obviously it's, people are upset about this, that it's fully centralized. I mean, what do you expect? Stablecoins generally are never decentralized, and the ones that are haven't really lived to tell about it. So really no surprise on that front. It'll be interesting to see. Again, is anyone going to use this thing? I don't know. But I think all companies are looking at, in the payment space at least, looking at what Tether has done and looking at their profit margin and thinking, yeah, we could do this. So I think it's bullish if PayPal is on our side fighting for regulations. That may be careful what you wish for type thing, but it's a positive sign in some regard relative to what this thing actually is, right? So, bit of a give and take on that front. Before we get any further, let me talk about today's video sponsor, KrakenPro. KrakenPro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. KrakenPro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out KrakenPro with the link in the description of this video. And if you didn't catch yesterday's video, I talked a lot about Tether and what was going on with the Tether market price. That has recovered quite a bit. This is Kraken's USDT-USD pair. Kind of as people suspected, with wires being open, ARBs being able to do their job efficiently. This is slowly closing, even though Bitcoin curling down, Binance Premium expanding, and the Tether price not quite back to $1. So on the crypto side of things, definitely not too bullish until this stuff clears up at the very least. And then the last little crypto nugget, this is, a small country in the UK, saying, I don't know what bank this is, I don't know who this is, but I don't even know if this is from today, right? Anything I see on Twitter these days, I just assume is probably fake, but who knows? This looks legit. Anyway, point is, if we're limiting inflows on the retail side, not that retail has any money to throw at crypto anymore, but if we're limiting flows on the banking side of things, that's certainly going to hurt crypto in the long term, especially when things start to pick up, unless there are alternative means to get money into the ecosystem. Just a small example of that. All right, on to the macro stuff. So Trueflation, a real-time estimate of inflation, continues to hold above 2%, below 3%. The rate of decline has definitely leveled off, we'll put it like that. And we're not yet to the Fed's target, which at this point we may never get to. What are they going to have to raise to 10%? Just kill everything and hope for the best. The next CPI prints are in August, September. So we have one this week. And I can't imagine if CPI is elevated, if CPI is above 3, I can't imagine the markets are going to be happy about that. We're already seeing some weakness on the legacy side of things. As far as rates are concerned, next meeting isn't until September, the end of September. So plenty of time for these probabilities to get sloshed around. Currently, most people are expecting the Fed to hold here based on probabilities. If we look at the banks as well, most of the banking predictions, the research predictions, are that the Fed is likely to hold, but this, can change at any data point whim. I would think CPI and unemployment being the most two two most important factors there. So we got plenty of time to change minds and decisions there. And, if you measure inflation and you dice and slice it apart and you look at it in a specific way, this is specifically multivariate core. I don't know if I've seen as many different variations on stuff like this, but hey, I guess if you're deciding on rates, you want different data points. I don't know. It just seems like we're just guessing and making stuff up here. Point is, this multivariate core trend is still declining. So from this regard, we're headed in the right direction. From everything else I'm seeing, credit-wise, we're definitely headed in the wrong direction. And there are still some Fed governors talking about continuing the need for further hikes. And again, that 2% target continues to be where they want to get. So we're not quite there yet. And if we put it all together, if we look at CPI, core PCE, trueflation, Fed funds rate probabilities, and I added Fed Nowcast, which is kind of the Fed's version of trueflation. So the Fed Nowcast is predicting inflation to creep up again. So we'll see what happens in the next 3 days here, if Nowcast is correct, or if trueflation is correct, or if it's somewhere in the middle. But I'll take anything at 3 or below 3 as a win, anything above 3, and that likely signals the need for more hikes. You're going to see those probabilities for more hikes continue to increase. But we do have another CPI print, so if you want max volatility in the markets, we get a CPI print that's down less than 3 this month and then above 3 next month, something crazy like that. So these two prints are going to be crucial on the CPI side of things. Now they will have several, speaking appearances to talk to the market effectively before the next FOMC meeting, but I don't think anybody is blanketly bullish on inflation expectations here just yet. Looking at the 10-year Treasury yield, as Game of Trades is pointing out, the last time we were up here, bad things happened. So if we experience some more bad things here, if we get some more regional bank failures, again, we had a little one 2 weeks ago, under 200 million. But if we start to get a domino effect of bankruptcies or regional bank failures or something, that gets the Fed's attention, certainly more likely that they pause, but also more likely that we tip over, enter recession period. So I don't think any bad news is truly good news, even though initially the market may react to that. And if the Fed needs to come up with another facility to bail out banks, then some sort of CRE facility equivalent for the BTFP program, I don't know. If they have to do that, then risk assets continue to party because we're putting liquidity back in the system. Another chart, I think, from Game of Trades saying, look, unemployment peaks when we're fully uninverted. So talking about unemployment rising down here is kind of foolish. Until the yield curve starts to uninvert, then that's when we're in trouble, right? So yes, this does precede a recession. This does precede bad things happening, but we're not quite there yet. I think everybody's looking at this. The bears and the doomers are looking at this saying, it's inevitable. We're headed for a rise in unemployment. Plan accordingly. And the optimists are saying, look, we're not there yet. We got plenty of time, right? We can still play in risk assets until things start to explode. Meanwhile, in Canada, though, Canada jobless rate has been increasing. So not completely rosy all over the world. I know it's just one country, but they are adjacent to us at the very least. And this is really, again, if we're talking about doomer things heading in the wrong direction, why do we want sound money, hard money? Looking at things like this, it's like, okay, does that matter? If it doesn't, then who cares, right? But at some point you think that this will catch up to the world. The US is 33 trillion of this. But you think at some point something's got to give. And seeing this chart is also very sobering. US debt is expected to rise by 5.2 billion every day for the next 10 years. Again, headed in the wrong direction. Either it doesn't matter or it does. It feels very binary. Either something's going to explode and we're going to have to reel this in, or who cares, right? Who cares? Run it up, run it to 50 trillion, 100 trillion. What does it even matter? I think logic would suggest that it does matter and that we would eventually lose our world reserve currency status along the way, along the path here. So we'll see. We'll see if we have a come to Jesus moment, if we have an event where things turn a corner. But looking at credit cards, they have reached $1 trillion in the US. And look, I don't have much to say other than we're headed in the wrong direction. I don't know. What do you do? What do you do? Does it matter? Does it matter that we're at $1 trillion? Does it matter that defaults on the lower end of the spectrum are extremely high right now? I would think it would matter eventually. I would think it would matter that average credit card rates are 21% and rising. And if you have bad credit, forget it. This is average 30%. So that's a yikes from a interest rate perspective. And again, I don't want to be a doomer, but none of these numbers say to me, yeah, things are great. Things are going well. 36% of US adults with more credit card debt than savings. And then if we talk about housing, again, mortgage rates extremely high, highest they've been since 2000. And that's fine historically if home prices come down, but that's not what we're seeing at all. And this is kind of a duh. Of course, mortgage applications are falling. That's what you'd expect. And if you're the Fed, arguably that's what you'd want. You want tighter credit across the board. You want spending to slow down. But if the consumer is getting tightened and the government is not, the Fed's overall ability to rein things in may be dampened a bit. And here's the chart showing new homes versus existing homes, showing that existing homes are actually more expensive than new homes. So we're not seeing any relief in a big way. This is highly variable based on region, like we talk about every week, but no relief across the board for home prices relative to rates. You also have these stories of, people want to move, but they can't because they're locked into this great mortgage rate. And I say, here's my little violin, boo-hoo. You still have a 2 to 3% mortgage or 3 to 4%, and you've got a house that's appreciating rapidly. Some more data from Nick Timmerhouse just showing, where we're seeing increases in home prices. And it'll be interesting how this works its way into CPI. Again, that data is super, super lagging. So this may not even matter in today terms. It'll matter 6 months from now, but definitely highly regional. And I don't know where exactly this fits into the equation other than things are just getting more expensive across the board. Again, highly regional, depending on where you are, but nothing's getting cheaper. I can say that much. And again, we're talking about car loans, right? Percentage of state residents paying over $1,000 a month in Q2 2023. Outrageous, especially in Texas and Wyoming, which car dealership guy argues that's due to large trucks. So I don't think we're seeing relief on the credit side of things just yet. The spending side of things, yes. I don't have a consumer savings graph for you this week, but we're getting closer to the point where people are just tapped out. If you're paying 30% on a credit card, how long can that last before your credit's gone, right? I don't know. That's just a wild stat to me. Moving on to the S&P, not too much has changed week over week here. It still looks like it's headed for lower to me. It still looks like we're cooling down at the very least. Technicals reached their logical conclusion here. The next point at which you'd expect a move is somewhere at the daily Kijun on the cloud. And if things get turbo bear, it would be all the way back to the 200-day moving average, which certainly isn't my base case, but I do like 43 something and change. And then this is from the short bear, so keep that in mind. But if we look at the last 10 years of the S&P, and we look at August and September, in pre-election years, much like pre-halving years for Bitcoin, these have been down and muted months, so not exactly hyper bullish on seasonality. And Nasdaq's the same. This thing is just absolutely screaming. And it looks like I've got the crypto cloud on here, but it doesn't really matter. Either way, it's telling you, yes, things can get quite ugly. And this is QQQ, at least on the retrace. Plenty of downside, 10% downside potentially here. 200-day moving average, much lower. So some minimal mean reversion, I think, is still in the cards there. Looking at DXY, everybody, including myself, got excited when DXY got crushed. But DXY since then has climbed quite a bit and is really just back into that triangle. So as long as we don't see higher highs, we will be okay on the risk asset side of things. Now, if CPI comes in hot and there's an expectation that we need to keep raising, I would think CPI continues to move higher. A CPI above, we'll say 103, any higher high here might just be devastating in the near term. But at the end of the day, it doesn't really matter until after halving. So let DXY have its day in the sun. Ultimately, it would be most damaging if the dollar strengthens post BTC halving. That's what we definitely don't want to see, and relative to where we'd expect rates to come down or some sort of recession, that's likely to happen closer to halving and or after halving. And for me, I'd expect the DXY to calm down, dollar strength to calm down around those times. Gold, not much is happening here either, even though I know the doomers think gold's going to infinity, which, hey, maybe they're going to be right in 2100, I don't know. But as it stands here, based on technicals, still in the range, still quiet, not much going on, much like ETH. Until it's back above 2K, I don't really care about gold. Now, unlike gold, oil on the daily cloud had a massive breakout in July, showing this TKC clamp here, but it's also got an Adam and Eve double bottom. So it's bullish on trend. It's holding a bullish continuation expectation after a year-long downtrend. And you would think eventually this does move higher, very likely moves to that 90 handle or mid 90 area, purely based on technicals, which at the end of the day, bake in everything going on in the real world, but I don't think that's out of the question. And if we look at Tavi, my buddy Tavi on Twitter, Chief Doomer, this isn't really a doomer chart, it's just, the reality. Oil demand is at record levels and OPEC is cutting. So we have the oil, we're just sort of artificially increasing price, and that's part of what a cartel does. But that isn't to say when we reach some magic level, maybe at 87, the OPEC says, okay, we're going to start increasing our output again. I don't know. So that's definitely something to watch, probably, if you're trading oil. And, everybody and their mother's crying about the SPR. I would love to see what would happen if Trump was doing this. Would people still be crying about the SPR? Because I doubt it. Do we need the SPR? I don't know. Maybe that's a take that'll age like milk, but that's a really good question. I wouldn't have minded if they drained the SPR and then refilled it like they said they were going to. The problem is they haven't refilled it, and now it's extremely low. And if this matters to OPEC, and they're trying to turn the screws on the rack here and say, okay, we're going to keep oil prices way above where the US wants to refill its SPR, and they want to continue to play that game, they can. I just think it's very interesting how we've politicized the SPR, the strategic political reserve, call it whatever you want. I don't even care, right? I'm glad they drained it. I'm glad that prices came down. Good for them. But it was definitely a miss when they didn't attempt to refill it, at least in a bigger way. So you can look at this and say they've only got 3 weeks of oil demand for the US, blah, blah, blah. Sure. But I think we'll be okay. And natural gas prices continue to rise here on that oil strength. So again, not great for inflation. And you're hearing a lot of people talk about the rise in gas prices in the US with inflation expectations also rising. So if energy costs go up, look out for that hot CPI. And then just across the board, looking at the big six, general weakness, general mean reversion. Meta and NVDA probably the strongest among these. Apple definitely the weakest. Looking like pulling back here is not the end of the world, considering these runs have just been absolutely wild. I think we'll be okay. I see a lot of people kind of panicking and expecting rolling over to pre-bull market lows. I think things are going to be okay. Things are going to mean revert. It's not the end of the world on that front. Coin also mean reverting, right back to the Kijun. Hood, same thing. MSTR, same thing. And I talked a lot about this on Friday with the mining stocks. All of those are mean reverting as well. So from here on out, this may lead to continuation based on trend metrics. I don't think that's a high likelihood, especially if CPI comes in hot this week. So I think a lot hinges on that. And a lot hinges on the expectations of the Fed in September. But hey, if CPI comes in less than 3, full party time, baby. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.